As market conditions remain volatile and companies are exposed to various financial and liquidity pressures, both borrowers and lenders may look to reduce or restructure their debt obligations. Borrowers may be seeking a debt restructuring because they're not able to meet current loan covenants or cash flow requirements under their loans. Lenders may be willing to work with borrowers because they realize that it may be in their best interest to reconsider the terms of a loan instead of forcing the borrower to find another lender or file for bankruptcy or foreclose on any collateralized assets. As a result of these renegotiation processes, the borrower and lender may agree to modify or restructure an existing loan or exchange one loan for another. The transaction and events occur in these settings can have significant and sometimes unique financial reporting consequences. Companies often consider a variety of potential transactions with creditors or security holders to either deleverage or otherwise enhance liquidity. The transactions may involve cash settlement, an issuance of equity for debt, an exchange of debt, or a modification of debt terms. Most of these transactions occur outside of a bankruptcy or a Chapter 11 filing setting, either through a renegotiation or a tender offer process. However, sometimes these transactions precipitate a Chapter 11 filing in order to consummate a debt restructuring process. Depending on the facts and circumstances, there are various accounting considerations a borrower should anticipate when dealing with a debt restructuring. From both an accounting and a tax perspective, a significant variable is whether the debt restructuring creates income or loss at the time of the transaction. Extinguishing debt may result from a payment or exchange of assets, an issuance of stock, or from an exchange of debt instruments that have substantially different terms from their original security. Depending on the circumstances, an extinguishment of debt may be full or partial. A thorough analysis of the borrower's facts and circumstances is required to ultimately determine how the borrower should account for modification, restructuring, or exchange. In the case of an exchange of debt instruments, the borrower must first determine whether certain criteria are met for the exchange to be classified a troubled debt restructuring. In short, a troubled debt restructuring is when the lender, due to economic or legal reasons, grants a concession to the borrower that it would not otherwise consider. For example, changing the amount of timing of repayment and/or modifying the interest rate terms. If the troubled debt restructuring criteria are met, then an extinguishment gain generally is recognized as long as the cash flows of the new debt instrument are less than the carrying value of the old debt instrument. Otherwise, the gain is carried over as part of the principal balance of the new debt instrument. There are several tax considerations a borrower must also consider when contemplating a debt restructuring. For U.S. tax purposes, settlement of a debt at a discount normally creates debt cancellation income. Exchanges or significant modifications of publicly traded debt instruments usually create income for the difference between the fair value and the tax basis of the debt. Modifications or exchanges involving private debt obligations do not generally result in taxable income or a loss, but prospectively adjust interest deductions. Additionally, a taxable modification or exchange of debt typically results in an original issue discount, or OID, on the modified or new debt. This OID is amortized over the remaining term of the debt. When a company is operating through a bankruptcy or Chapter 11 process, there are several key considerations that arise. The financial statements for a company prior to filing bankruptcy will differ from those during the bankruptcy period. Accounting treatment during these times are governed by the guidance of AICPA Statement of Position 90-7, which is the financial reporting in reorganization under the Bankruptcy Code. If the company that files for Chapter 11 is a subsidiary of a company not in bankruptcy, the subsidiary is deconsolidated for financial reporting purposes because the parent no longer controls that subsidiary. The company that emerges from bankruptcy is a new reporting entity, with financial statements presented for the predecessor entity during bankruptcy and the successor entity from emergence onward. There are certain balance sheet impacts for companies operating through a Chapter 11 process. The balance sheet for companies are distinguished between pre-petition liabilities subject to compromise, which may be settled for lesser than their face amount, and those that are not subject to compromise, i.e. fully secured claims. Pre-petition liabilities and claims are generally reported at the full dollar amount of the claim and not at some forecasted discount amount. Interest is only accrued to the extent it will be paid during the final proceeding, or it's probable that it will be deemed an allowable claim. Additionally, there are several income statement impacts that affect a company operating through a Chapter 11 process. The income statement separately shows the results of ongoing operations from the activities related to the reorganized or restructured business. Gains or losses resulting from restructuring adjustments to the carrying amount of pre-petition liabilities, the effects of extinguishing debt, adjustments resulting from fresh start accounting, and other costs directly related to the bankruptcy proceedings are classified separately as reorganization items. Bringing this all together, debt restructurings and bankruptcy present unique financial reporting and tax consideration. PwC, through its multidisciplinary capabilities, that of audit, tax, advisory, including our business recovery services, work in close coordination with those responsible within a company for financial reporting and income taxes.